Welcome to the Broken Pie Chart Podcast, episode 353. I'm your host, Derek Moore, back again, Mike Snyder and Shane Skinner. All right, this is kind of like a makeup episode because we never could get our stuff together around the Thanksgiving holiday. I had some travel. Mike and you had some travel. Shane, you were probably just cold at home. And so we'll do this one and then we'll do another one this week. So you get like two. I'll tell you what is, I don't know, like we got to talk about interest rate cuts. And it's a 93% probability right now that the Fed cuts at the December meeting. I feel like the Fed is not disappointed based upon the expectations yet. But Shane, I'll go to you first. I mean, the market feels like it's just waiting for this. But based upon the probabilities, I think the market's already decided, and we see that in the price movement.
Yeah, absolutely. I know Powell and one of his last
remarks. You know him personally?
No, I wish.
Okay.
I know he said in one of his last big interviews that the market should just be so certain of itself to price in the expectation of what he's going to do, or the Fed is going to do, I should say. And that, they're data dependent or driven. At the end of the day, I think that, they're focused on making sure the labor market, like inflation's back under control from what it seems like, right? And so I think they're more focused on getting the labor market some relief as we're seeing, cuts, less hiring here and there. I think there's no excuse not to. So we'll see.
Mike, I was looking at the most obvious place is the Russell 2000. And I'm looking and we don't really talk about this very much, but the Russell 2000, according to Wall Street analyst on Bloomberg, 34.62% earnings growth projected over the next 12 months. That's a lot. It's priced to forward estimate is 24.8. I don't know. I mean, is the Russell, is that why the Russell is basically, did it make another all-time high today?
It got close. Yeah, I mean, the Russell's a great indicator of where interest rates might be headed, especially recently. If you look at the chart, the Russell sold off as this next rate cut, in November became less certain after that speech that Powell mentioned that Shane just talked about. And here over the past week or so, as it has sort of seemed like, okay, the cut's looking like it's going to be more certain. It's up about 6%. So the small caps are certainly expecting a cut here along with the rest of the market.
The reason why the small caps enjoy the cut, as people say, more than others is because their cost of financing is probably higher. Like if Apple or Nvidia, Google want to go borrow money, it's going to be high-rated paper, good rates. Those companies may not get the same financing rate, and so a lowering of interest rates, and they have more debt. At least that's the thought on Wall Street. But the idea is that as you go down in rates, their interest rate cost on the income statement comes down, and that could potentially increase their earnings, make them earnings positive. A lot of those companies in the Russell 2000 don't earn. So, and I got to be honest with that. I didn't catch this at first, but Shane, if you're looking at the chart of the Russell 2000 index, and look, who knows what's going to happen here, but this is kind of like, it's not perfect. I don't know if I'd put this in a textbook. A little bit like a cup and handle, maybe a vase and handle. And cup and handles, of course, is a technical pattern where you have this sort of pattern that dips down almost like the shape of a cup. In this case, it's more of a vase, like a V-shaped. And then it comes up, reaches a plateau, comes back down, goes back up, but that's not as deep. If this thing breaks, if this is a cup and handle and it breaks out, like, again, who knows? I'll let you know when I know. But if we get a breakout here, Shane, like, I don't know. I mean, this is kind of saying rates are going down.
Yeah, absolutely. I agree on the take that, there's a clear alignment between the performance of the Russell and interest rate expectations. I'm just to cover the other side, going to say, nothing's ever a guarantee, and that trend could eventually break. But yeah, you had a huge pull back and retracement in a pretty short time. You're talking about October 15th, you topped and you bottomed, or at least a recent bottom, on November 20th. So you had about a month of selling from the high to the recent low, and in a fraction of that time, like we said, since the 20th till now, you closed the day 30 points off of that previous high. So I mean, yeah, it's almost been a V-shaped recovery here. There is a little bit of a cup and handle, if you will, or cup and vase on the 4-hour, daily, weekly, however you want to sort of draw it up. And yeah, I mean, if we see a breakout, these patterns typically have some pretty strong, upside moves after the fact. So maybe it's not just rate cuts coming, but even more aggressive after the fact.
All right. Shane, the other thing I think we need to look at too is the high yield spread. So when we look at the high yield spread, it is, of course, the difference between the yield in high yield bonds and treasuries. That had started to widen, and that's always one of the things people watch. They watch the high yield spread, and I watch it because when spreads widen, that's really an indication that risk is coming off, that the yield demanded in quote unquote high yield paper or high yield bonds is higher now because the risk is separating from treasuries. We saw it move up to about 319 basis points. It's back down, about 290 basis points. I mean, Mike, we said this too we have kind of a trader group chat that we use sometimes. And remember when the market was down, we're like, well, high yield's not down. So who's wrong? Is it the market or is it high yield? Is high yield yet to go down and it's wrong? No, Mike, the yield spread has come back in.
Yeah. So it appears that, at least for the time, the market was wrong, right?
Market was wrong.
And funny enough, it was Apple. It was Apple and high yield that seemed to be right as the market was selling off. And here we are. We have, the NASDAQ and the S&P having, rallied off that sell-off. Not quite back to all-time highs, but within shouting distance for sure.
I'm looking at the CNN Fear and Greed Index. And, I think yields are a part of that. And when we look at that, I'm like, is this thing broken? And the reason why I say that is we're just on the precipice of extreme fear, between extreme fear and fear. And the market high yield spreads are coming back in. Volatility has come off. And the market seems like it's making another run at a new all-time high. Like when I look at this, and I just sent this to you guys as I'm talking about it, I mean, the components are there. It looks at market momentum, and that's neutral. Stock price strength, so net new 52-week highs and lows on the NYSE. It says it's extreme fear. Okay. Stock price breadth is extreme fear. And what that is, it looks at the amount or the volume of shares on the NYSE that are rising compared to the number of shares that are falling. A low or even negative number is a bearish sign. I mean, I don't think this is extreme fear, but okay, I'll move on. The put call ratio, fear, and a ratio above 1 is considered bearish. It's right now, it's like 0.65. And market volatility is neutral. Safe haven demand, I won't get into that. Junk bond demand. I don't know, like, is this thing broken? Like, and maybe this is one of the reasons why the market continues to go up. If there's this much fear in the market, and I have some questions about how they're doing this, but isn't that saying like,
Yeah.
this rally's not like, how do you have a bubble when there's this much fear?
So I don't think it's necessarily a question. Sorry, I cut you off, Mike, if you had a comment. I wanted to hop on this first. I don't think it's necessarily a question of a bubble or not. Whether there's a bubble or not, the actual micro effect of hedging, right? Like if nobody's selling a ton of assets and instead they're just hedging their assets with puts, I think what starts to drive the market more is the reflexiveness of the process of putting those hedges on and then unwinding them. And we've talked about this before. I don't want to bore our viewers any more than we have with this, but there is a process of when you put a hedge on, when you buy puts, the market maker that fills that sells them, and then they're going to have to hedge that. And then when you take it off, they're buying them. And when they buy them, they have to hedge it the other way, which typically involves selling and then buying the underlying or futures, based on you buying and selling the protection in that order. And so I think we're just in such an options heavy driven market. And along with that, you're not necessarily seeing as many equity sales taking place right now. I think when abnormal selling volume comes in, I think we see movements much lower than normal. But it is weird getting the data that is coming out. It doesn't necessarily look great. I'm not saying it looks awful, but there are jobs reports coming out here and there. The ADP today wasn't beautiful. You've had VIX almost hit 30 twice in 2 different times in the past 2 months. And, I think there's just a lot of people that don't know how to make out a lot of what's going on, like what they think or feel. And like you said, buying more protection, and maybe that's why it's actually holding.
Mike, I mean, what are your thoughts on this? I feel like people are just waiting for a shoe to drop here. And they've been waiting for a long time. And before you comment, Mike, Eric Baltunas sent something out on Twitter. It says, merchants of doom were wrong again. The S&P 500 just clocked its 7 straight up months since Liberation Day. If it ends December up, it will only be the 4th time ever in 32 years since SPY launched. While economists and columnists swung and missed all year, ETF investors nailed it, pouring money into equity ETFs. Mike, like how is fear this high? We just had.
It's an odd or maybe a different market. You have a technology that I think generally people are still getting acquainted with and trying to understand how it's going to shape the future, not just of our everyday lives, but the economy and the market itself, and who's going to be winners and who's going to be losers in that race, which seems like there's starting to be some potential separation there with AI. And, you still have a good amount of stocks that are negative for the year while the overall market is up. I would say I don't have the exact figure in front of me, but I know recently it was higher than usual, higher than what you would expect in terms of stocks that are negative on the year in the index, with the index being where it is. So you have this, new technology, you have really just a few concentrated positions that are driving a lot of the return. I think that is scary in some ways, and kind of agree with what Shane was just saying about, people not necessarily selling their positions, but maybe purchasing protection because one, it's been a great run in this market, and maybe some people are just wanting to protect some of those gains, and then two, having these few stocks just make up so much of the return. It adds some concentration risk that we typically don't see.
I mean, the sectors are doing, besides consumer staples, I think that's the one, and energy. The sectors are all near all-time highs too. I mean, and I know like semiconductors as a subsector, sure, that's driving towards new all-time highs now. I mean, it's just this weird dichotomy of people are saying things are awful, sentiment's really bad. People are waiting for the shoe to drop in the markets, but yet Charlie Bolello, I had something else I was going to bring up from him. Eric Baltunas, talked about the SPY. So I don't know. I mean, Shane, to your point, ADP, which is a private company that does payrolls for a lot of companies, and the U.S. lost an average of 4,000 private sector jobs per month over the last 3 months per ADP data, the first 3-month decline since the 2020 recession. A year ago, we were adding 200,000 jobs per month. Charlie Bolello tweeting that out. So, yeah, I mean, look, Shane, also, you brought it up. I mean, obviously, ADP data hasn't been as good. Maybe people are using a different service than ADP. I mean, maybe. But U.S. unemployment rate moved up to 4.4% in September, the highest level since October of 2021. 4.4, though, is still really low. Still really low, Shane. So I know that it's not great. But, the other thing, this is from the Daily Shot, and I'll let you kind of comment on it. U.S. growth rate implied by soft data has turned south. By contrast, hard data have held up, implying trend growth. Soft data is like surveys. Hard data is what really happens. Two different opinions. And we still haven't seen inflation. We haven't seen it go to 2%, but we haven't seen it rise. So I don't know, Shane. I mean, this is one of those things. This is why we buy, we hedge. But I don't think the hard data is really telling a bad story yet. I don't disagree that employment is not as strong as it was.
Yeah, I think that's a fair statement. I need more data and I need to research more myself, periods throughout the market and unemployment levels, and just see if there's any kind of trend or valuable information we could pull from that. But, like you said, that's not that many when you think about the total number of jobs in the private sector and the grand scheme. And, these are still jobs and they're affecting people. So it matters, right? But at the same time, the market seems to absorb stuff like that pretty well, right? And so you went back to like waiting for the other shoe to drop earlier in this. I really think that's what a lot of this seems to be, is it's like every piece of bad information is really like the people who are concerned about it make a lot of noise and they're very concerned, right? They might have some valid points, but at the end of the day, if it's not enough to drive selling or cause selling pressure to, be outside of what I think is become the norm on a day-to-day, week-to-week, month-to-month basis, then the market's probably going to continue to hold and go higher, right? But who knows, right?
Michael Kantro. He's from Piper Sandler. He had this thing that he calls HOPE, and it's housing, new orders, profits, and employment. And his point is the first to slow normally is housing, second to slow, new orders, third to slow, profits, and the most lagging part of the economy is employment. Mike, if I was going to say, I mean, is housing slowing? It's the rate of change of homeowners, buying and selling has slowed because of interest rates are so high. We're in kind of this weird period. I don't think housing prices are going down. Orders, I don't know. You look at the S&P 500 estimates for sales growth over the next 12 months, and you look at the net margins, you look at earnings growth. So new orders and profits seems to be okay, at least judging by the S&P 500. That could change tomorrow. And then usually the most lagging part of the economy is employment. And employment is tough because a lot of times it's lagging, but if there's a problem, all of a sudden you see it. And so I don't know, like, is employment not growing as much? Is that really a problem? Like, this is all out of whack here. If hope is the normal order of things, Mike.
Yeah, I think employment not growing as much, I don't think that that's a huge issue at this point. I think the market sort of showed that today. They'd rather have lower rates, and they're fine with the level of employment. So I don't think that's a huge issue. I think, like you said, housing, we are in this weird sort of time where where rates are, people just aren't moving because they don't want to get out of their current lower rate that they got a few years ago, or first time homeowners are waiting for rates to come down and continue to come down before they enter into the housing market. So it does sort of feel like a weird time. I agree.
We also have this 4-year presidential cycle thing. We have the Santa Claus rally. First on the 4-year presidential election cycle. So in a typical fashion, you have the first year is usually up. The year of the midterms, typically, you'll kind of go a little bit sideways, but then end up post-election kind of making a run. Year 3 is usually pretty good. Year 4 is usually pretty good. JC Peretz, I didn't see the comment, but he has this is his chart from All Star Stats. He says trend is more important than level. So if this follows suit, you would say, well, next year's a midterm, and maybe we go a little bit sideways for a while. And it's not unheard of that markets they don't have to go up just because earnings are going up. They could go sideways. Earnings could still go up. The valuations get better. Like, there's a case to be made that it could be good economically. It could be good earnings wise and sales growth wise, but the market doesn't have to comply. The market could go sideways. So, I mean, maybe that's a little bit of a headwind. If you're trying to make the bear case, you'd say, okay, we're coming into the second part of that. Shane, the other part is the Santa Claus rally. So Santa Claus rally typically is the end of the year into January tends to be a good part of the year historically, right?
Yeah. It's I think it's probably one of the more heavily argued seasonal phenomena, if you will. Some people buy into seasonality, some people don't. Someone's always right? We either usually go up or down. So I don't know. It's been a really strong year. You had a really, really big bounce recently. If you're looking at it from the S&P standpoint, we hit the high of 69.20. And within 3 weeks after that, we hit a low of 65.25. I mean, that's about a 400-point drop, right? In a 3-week period. That's not the end of the world, but that's, not a small amount of money either, or a small move. And so to be back up at 68.50 essentially at the close today, 68.49, you're talking we're 70 points off the all-time highs, and we've got 4 more weeks of this thing. I don't see how. I don't know. It just seems like it's on a path here, and least resistance to the upside. But we'll see.
The other thing so I'm going to disagree with a point that I keep hearing on TV and with some of the pundits and people get interviewed, and this is a market of only a few stocks. If you look at VT, that's Victory Tom, the symbol, that's the Vanguard total stock market index. That's like everything in the world, so to speak. You pull up that chart and you overlay a chart of the SPY, it's the same thing. You look at EFA, it's up. EEM, it's up. You look at different, Germany, you look at Poland, let me look at Argentina. See, I know Argentina had a little bit of a rough go. Yeah, Argentina it's within its most recent. Like when they say it's only, it's the Mag 7, it's the big stocks. I disagree.
Assets.
What's the RSP? RSP is the equal weight. Equal weight, near an all-time high. Like you can't tell me this is only certain number of stocks. I think that's just lazy. And I know the breadth is one thing. I get it. I get why people do that. And I get why people say, well, all the earnings are coming from a certain amount of companies. But you can't have the total stock market. You can't have EEM, which does not have NVIDIA, does not have Google, does not have Apple, does not have Meta, Microsoft, Avgo, Broadcom, whatever the heck you call it. I mean, Mike, you look at these charts, it's like they're all singing from the same songbook, right?
Yeah, I mean, almost any fund you're in that's long equities, you're making money this year. So yeah, I mean, it's hard to argue. I get on the surface why you look at the S&P and you see the heavy weightings and you're thinking, it's just these 5 stocks. But like you said, there's IWM is up. You have international markets up. So you really can't just say it's all NVIDIA or 5 stocks.
I mean, energy, look at the XLE. So XLE that's not a great chart. I mean, I'm not saying it's going to go down. I'm saying doesn't look like the others. Like there's an example. But
NVIDIA is 15% off its all-time highs. And Meta's another one. Meta's at 640 right now. We topped at almost 800. So you're 160 off 800. There's almost 25%, right? You've got a lot of big names that have pulled back, and yet the index has held.
United Healthcare, which is a pretty big stock, is off 300 points from its all-time high. I think it's still 300 points. Maybe it's 290. It's so yeah. I mean, I think it's just lazy.
I think that's a testament that money's not coming out of this market. If it's getting taken out of one name, it's likely being repurposed into another one.
I just think people are buying they're buying the ETFs. I think they're buying the index ETFs, and people are still buying in their 401ks. Like money is not coming. I don't think money's coming out of this. We're not seeing the flows. Money has come out of crypto. It is not necessarily jamming into energy. What is staples, or what's the sector spider, the symbol for the staples or cyclicals? What's that? XL. I can't remember what that one is. Energy, industrials. Real estate's not probably great. Yeah, real estate doesn't look great if you look at that as a subsector or a sector. Industrials. So yeah. Look at Intel too. Did anybody have Intel on their bingo card? Like more than doubling since July?
No. We talked about that before their earnings. I remember a few weeks ago, and I was shocked at the volatility in that. That was a stock that sort of just written off as one of those stocks that was going to be sideways for a long time.
The other argument, when Target reported, they said, well, the consumer is softening, but look at Walmart. Like, look at Target, then look at Walmart. It's like, is one of them upside down?
Yeah.
So we're not fundamental analysts. I'm certainly not following Target and looking at their financials and doing channel checks and going into their stores. But Walmart versus Target, I would say, are they the same? Somebody who's very knowledgeable about those and an analyst covering them would say, well, no, not really. Certainly Walmart has a better online business and e-commerce business. But, when I look at a chart like that, I say, I don't know anything about the fundamentals, but I would say I would have to look like what's going on there that they're performing so much different than Walmart. So, I think we're in this market where individual companies who may be having issues or are not performing the same as the others, I think the market is sending a message on those. But for the whole market, it's been pretty good. It's definitely been pretty good. I'm looking for anything else that Do we have to talk about Bitcoin? I guess we have to, right? Fine, I'll talk. I'll go first.
I mean, hey, look. Okay, as much as we've dogged MicroStrategy, the past, I should say we've been critical, right? Bitcoin seems to be catching here.
Vanguard. So the story yesterday, I saw this on Bloomberg, was I believe they're going to allow, is it Bitcoin ETFs to be traded on their platform now? Is that what I read? I might be getting that completely wrong. And that's
no, I believe that's correct.
Yeah, and so like our conversations about MicroStrategies is that the vehicle versus Bitcoin? And we looked at the premium you were paying for MicroStrategies versus Bitcoin. We talked about Jim Chanos, who was short MicroStrategies, long Bitcoin. He's since closed out that trade. But yeah, I mean, I go back to when you have something like a Bitcoin or Ethereum in an ETF, those are people who are not just the super dedicated, crypto is changing the world, Bitcoin maximalist. Like those are people who are like, oh, this is going down, I think I'll sell. And you're seeing flows out. And that's what happens when you get flows. So Bitcoin was down more than 30% from its October peak. For most assets, this is a quote from IsabelNet on Twitter. For most assets, that would be a crash, but for Bitcoin, it's familiar kind of turbulence, sharp yet within its usual volatility range. Yeah, like if you own Bitcoin, 30% down, 30% up, like that's kind of to be expected, right?
Yeah, that's the deal with Bitcoin. When something goes up as much as Bitcoin has gone up, you got to expect it can go down just as quick, if not quicker. I did also see that, I think it was yesterday, Bank of America is backing a 4% crypto allocation for their wealth clients.
Oh, really?
Yes, up to a 4% crypto allocation. They're going to begin coverage, and this will take effect January 5th, which I thought was interesting for a big bank like that. It says like 15,000 advisors to make a shift like this.
That's
right.
inflows. That's potential inflows.
It's almost like though when everybody supports it.
Yeah,
so Yogi Berra had a quote, a Yankee great. He said that restaurant's so crowded nobody goes there. It was something like, I'm botching the quote, but all right, we talked about crypto. We can check the box. I want to go back to the economy, though. Deutsche Bank came out with their U.S. economic forecast, and let's see. Well, now I got to see how old this is. When did they put this out? Because they have 2025 as a forecast. All right, sometimes you get fooled on Twitter. I'm going to move away from this because I actually don't know. But you know what's coming up, guys? Year-end investment banks putting out their targets for year-end 2026 S&P 500.
I thought you were going to say our predictions for the
those
year.
are coming out too.
It's close to the same thing. We're not quite the investment bank, but you know, I like Mike's takes. I like Mike.
Well, I mean, look, it's we definitely do them. And I've always said it's very difficult because if you're making a prediction on what the market will be on December 31st of this year, if you're making the prediction on December 31st of this year to what the market level will be on December 31st of 2026, you're basically saying, I know on December 31st, 2026, what the forward EPS estimates will be and what the forward multiple will be on those estimates. And that's really what you're saying. You're like, okay, if we're going to be at a 22 multiple and these are the estimates, okay, I know where it's going to be. These are really hard. All right, here's something I wanted to bring up. Corporate buybacks and market returns move in tandem with roughly $5 billion a day in share repurchases. U.S. companies are keeping a solid bid under equities and softening every sell-off. You guys can't see this, but on the y-axis, it's the return of the S&P 500. On the x-axis, it is share buybacks. And no surprise, the more buybacks that happen, the better the market does. And I think companies have been doing buybacks. So that is, that's Shane, earlier you asked about, what's the wind in the sail of the market still? I think it's flows in. I think it's still the ever-present 401k money. And I think it's buybacks. And it's kind of interesting that companies, they really should buy back stock when things are falling apart. But of course, they preserve their cash, and sometimes they don't have cash. Like every company should have done massive buybacks in March of 2009, but no, they do them at all-time highs.
I actually looked into, could companies sell puts as a way to do buybacks, but I believe it creates like a Vega exposure risk on the book, or there's just something about it that can't be done proper. But I've always thought, why not let corporations sell puts on their stock? And as long as it's in line with the buyback program, you could do it that way, but it's probably a terrible idea. Probably never happen.
Well, you would make as a synthetic way to buy stock. I see what you're saying. You're quasi placing a limit order
shares, and they'll eventually just buy them back at a certain date. Like you determine a predetermined date they have to have them bought by, and up until that point, they can sell puts, take the stock if it's below, or make some extra money and buy it back later. I don't know.
I don't mind it. I'm sure there's some sort of corporate governance rule that prohibits companies from trading options on their own stock because insiders are although, yeah, I mean, in theory, you're buying back stock. It's really funny that companies buy back their stocks sometimes at the most inopportune times.
Right.
That's what Buffett would tell you. So, all right. So we'll be back doing another recording, I guess, in 2 days. That will be out Sunday. This one we'll put out. Our producer, hopefully, I'll let him know to produce this. And we never edit, but it is make sure our sound levels are even, and he does a great job with that. So this will come out. Before we leave, though, any recommendations? Mike, I'm going to go to you first.
Yeah. Watched The Lost Bus with Matthew McConaughey.
What's that on?
I think it's on Apple, I want to say.
Okay.
I'll double check that. It was good. It's a buy. It's about a bus that goes missing during the wildfires, or it's the campfire. I think it was in 2018 in California. And so this bus is filled with children, and Matthew McConaughey is the driver, and there's a teacher on the bus, and it's just about what this group of kids and the driver go through during this fire.
All right. I didn't see McConaughey doing a movie like that just for Apple TV Plus, but I like McConaughey. I think he's a good actor. All right, we'll check that out. How long is it? It's just a movie, though. I love the movies.
Yep.
Oh,
just
that's great. I'm in, because it's like an hour and a half, 2 hours of your life, and if it stinks, you're not committed to 17 episodes over. So, all right, we'll check that out. Shane, what do you got?
I swore I wouldn't do a holiday movie, but I'm gonna do one, and there's a reason. I'm gonna do A Christmas Story. It's one of my favorites, but in particularly, the story is in a fictional Homan, Indiana, but it's technically based on Hammond, Indiana, which is where it's like loosely based on where the original author is from. So Hammond, Indiana is fairly close to out where I am. So it's kind of crazy that such a prolific Christmas movie that's just sort of stood the test of time is based on a little town not too terribly far from where I'm at.
A Christmas Story is the one with You'll Shoot Your Eye Out, right?
Yep, Red Ryder BB gun.
And when the kid, he licks the pole when it's cold and his tongue gets caught. on it, right? That's the one.
That's the one.
That's the one. All right.
Yep.
I'm trying to think all right. So this will be out before the weekend. So my recommendation is to watch the final race in F1 in Abu Dhabi. There are 3 drivers who can win the Drivers' Championship. Max Verstappen, the current champion, who's won it a number of years in a row. Lando Norris and Oscar Piastri. So the last race of the year will actually mean something, and any 3 of those people might win it. So I'm recommending that. And you guys can make fun of me because I still watch. It's the only network show I watch, but I actually wait until most of the episodes are done, and then I just, bulk watch them. Survivor. So I've been watching Survivor, and you can make fun of me. I still watch it. It's the only network show I watch, though. So that's what I watched in the playoffs.
I respect it. That one's held.
And I gotta give a recommendation to the Chicago Blackhawks games. If you were in Chicago, I got the chance to go see a Blackhawks game. That is a really good environment. I know you both are in Chicago, and great hockey environment, good fans. Like everyone just has Blackhawks jerseys. Like maybe there was 1 or 2 people with Minnesota Wild jerseys, and maybe they were just lost. But good atmosphere there, as you both well know. All right.
Yep.
No comment from the Chicago people?
No, it's electric. It's a good time as long as the Hawks won.
They did not. They lost in overtime. But it looks good. Like watching him in person, he's clearly better than everybody else on the ice.
Yeah, he's made a huge leap this year, and he's just on fire. The team they're on their way back. So it's an exciting time to go. And the anthem there, if you haven't experienced that, a lot of fun.
Yeah, that reminded me of what the Rangers fans do in the playoffs. But yeah, just a random Wednesday night game, they start cheering during the anthem. So yeah, that guy seems like he's been singing the anthem for a long time there. I don't know if that's true.
Jim Cornelison, for not as long as you'd think. It actually started with Wayne Messmer in the early 90s during the Gulf War. That's when the chanting started. I think it was 92. The NHL All-Star Game was at the United Center. The Gulf War just started, and the fans stood and cheered during the anthem. So that's when that tradition started.
Was that Dennis Savard, Chelios era?
Yeah, it would have been.
Savard was like he was an artist on skates. That guy, he was awesome. So all right. All the other people have dropped off because we're talking Blackhawks 1990s. All right, we'll be back in a couple days, I guess. Go market. See you, everyone.